Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I'm the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a trained macroeconomist and a current certified financial planner. So today I'm here with Patrick Shea. Pat, good to see you again.
Thanks for having me, Drew.
So the markets have been pretty volatile over the last few weeks, particularly yesterday. We saw significant sell-offs in Japan, in the United States with the Nasdaq, the S&P and Dow. And there's been a lot of anxiety that's starting to form with the markets. So I wanted to kind of take a break from the normal episodes that we've been doing and really give investors our thoughts on the markets and what's happening. So today's truly just a market update. And the goal is to give you a sense of calm in the stormy seas right now. So I'm glad you're here. We're going to talk about the markets over the last, particularly the last couple of days. Even today has been really interesting, where we're starting to see the Nikkei in Japan pretty much fully recover a 12% loss from yesterday. Right. So what are your preliminary thoughts, Pat, on the markets right now?
Well, especially given the quick recovery in Japan, it does seem to be based more on sentiment than on fundamentals, and I think that is largely true, even in the American markets. Although I think the American markets it is coupled with stretched valuations for an extended period of time, with PE ratios being astronomically high compared to their historical averages, and so I think it is a true correction. I think in the U.S. And I think something that's healthy for the market and normal for the market. You had data on that, on the average downturns from peak to trough in a given year.
Yeah, I mean, one of the things I think investors forget is that markets are volatile year to year. So on average, according to JP Morgan has some great data called the Guide to the Markets, and in their most recent Guide to the Markets, they pointed out that the average intra-year decline is 14.2%. But if you look, and that's for the last basically 44 years, going back to 1980. But if you look at the last 44 years, 33 of those, or 75%, actually posted gains for the year. And so in the face of volatility, where you're going to see 14.2% average declines, and I've always made this point to clients, that on average, you will see a correction once per year. So everyone always seems a little shocked when we see these market downturns, and it's very typical for the markets to experience that. Even in a relatively healthy stock market environment, you will see these types of downturns. By the way, dips, which is a 5% pullback, we on average see 3 of those per year as well. And so I think one of the things that happened to investors is we got really spoiled after the 2008-9 financial crisis. From that period up until the COVID recession in 2020, we didn't see as much market volatility and we didn't see as much market movement. And because of that, people thought that that was normal, and that certainly was not a normal market environment. We're experiencing what I think is a very normal market, and these types of declines really are par for the course indeed. So yeah, I think investors need to be prepared for a level of volatility moving forward. That said, it's not like it's completely unfounded, some of this volatility. So the big driver of it over the last couple of days really came down to that unemployment report. So the hiring report came in lower than anticipated. It was supposed to be in the high 100,000 range in terms of hiring employees, and it came in the lower 100,000 range, and so that was a big disappointment. But the flip side of that is they're still hiring, though. It's not as if we're seeing a contraction in the labor force. But unemployment did tick up, so it ticked up from the prior month of 4.1 to 4.3%. So unemployment is moving up a little bit. And that first move in the wrong direction, I think, was a real jolt to the economy, and it's very much spooked investors. And I think, to your point, in Japan, it was very frightening for the Japanese. And I think they took it more as seemed a lot more emotional, like the 1987 crash, than what I think we're dealing with in the United States, which is a mixture of heavy emotions, but also excuses to take profits. and sort of return to normal valuations.
Right.
So let me talk a little bit about the unemployment, and I'd like you to talk a bit about the Fed. Basically, one of the things to remember about there's an old principle, and this is something that's important for investors to understand. And I will say this principle does not always hold, and it was disproven in the 1970s by Milton Friedman. So there's an old rule that there's an inverse relationship between inflation and unemployment. And although I don't fully agree, it's called the Phillips curve. Although I think the Phillips curve isn't a perfect measure, and I think it can be, it can easily be disproven in certain market environments. I do think in this type of a market environment, that principle can generally hold. And think about it logically. If the Fed is raising rates to basically drive inflation down, that sort of restriction of the economy, which think of the trickle effect, you're going to increase borrowing costs for businesses. It's going to increase mortgages for mortgage borrowers, for people that want to buy a new car, for their auto loan, for credit card rates. Like, things are becoming more expensive when you raise rates, which pulls money out of sort of the system, and that tightening effect can lead to things like unemployment. And so think about it. If you're a business and now all of a sudden you're servicing your debt at much higher percentages and you don't have as much discretionary revenue, what are you going to do? You're probably going to lay off some of your employees.
Right.
In fact, when I worked at the economic consulting firm, when we were looking at the later end of the cycle, the macro cycle, as you get past the peak and things start to decelerate, the growth rate decelerates, one of the common advice that we would give to our clients, is unfortunate as this may be, is that the first thing that people ought to look to do is to look to downsize their workforce. Because if you think about a business, it's very difficult to get rid of things like expensive capital goods. It's really easy to cut your employees, though. And for good or ill, that is the nature of how a market system works. And what is likely to occur when you experience a lot of tightening in terms of driving inflation down is you could see unemployment go up, which is why the Phillips curve, this inverse relationship, is still helpful but highly imperfect. But in this environment, I think it's particularly helpful because we should anticipate a slowdown in the economy. So here's the deal, and I think this is what every investor has been thinking about, and this is what almost every article, whether it's Forbes or Barron's or Wall Street Journal, what everyone's wondering is, well, if the Fed continues this tight trajectory by not lowering interest rates and keeping rates higher for longer, is this now just going to inevitably push us into that hard landing and therefore a recession? And so I think that is really what's been driving the anxiety in Japan. That's why they got upset and they started selling aggressively, overnight in the Japanese markets before we opened. They were selling off of that fear of recession because that unemployment bit went up. Now, there's another piece to this that I think I'd like you to talk a little bit about, and that's sort of what the Fed stance is. And I think that's also jolting the market. So talk to us a little bit about why is the Fed spooking the markets right now as well?
Right. Well, deciding to not cut rates when a rate cut was anticipated as early as last March. Now, you were, I think, on the money when you said it probably isn't going to happen until this fall.
I did predict that.
Yeah.
I was like, I really thought inflation was going to burn hot for longer than people anticipated for a variety of factors. But go ahead.
Yeah. And so the Fed, kept rates as high as they had been when they were trying to curtail inflation. And a number of investors and large institutions were very optimistic for an earlier rate cut. And I think that was reflected in the high valuations that we saw throughout this summer. Now, I believe they're saying, we'll probably cut in September. But they were sort of indicating that we'll probably cut in July, we'll probably cut in March. So, we still have yet to see if that's the case. But if you're, that relationship that you're talking about between unemployment and inflation, as inflation comes down, unemployment ticks up. And that, of course, makes sense if the cost of borrowing is higher and now you have to find a way to cut costs. So it seems like this is sort of a good indicator that employment ticked up a bit. An indicator that, the Fed is doing what it can to lower inflation, and we could sort of normalize and move back into, the middle of the cycle there. And I think, with that, another point you're making is like, this is just one data point, right? And so before people can say like, oh, this is a recession, you need to see a lot more than just one data point in unemployment or wherever that data point you're going to find. Like, you need multiple data points to actually call it a recession. And like you're saying, that the Nikkei bounced back today.
Almost all of it. I think it was up 11% by market close.
And the U.S. markets are ticking up a little bit this morning. So I don't see this as like a long bear market, at least not right now.
It's too premature, and I'm writing an article. We're launching a blog on our website where it's going to be pretty much exclusively econ and finance related. And in the article, I make the point that it's one data point, as you said. It's not a data set. It's a single point. And when you're trained in economics, you look for trends, and you can't find a trend with a single data point. So what I want to see is a true deterioration, a consistent trend that forms over time, that unemployment is ticking up. There's other things I also want to see. I want to see foreclosures on homes get worse. I want to see trends. The one trend we do see right now, and I've mentioned this before, that's bothersome, is that we are starting to see delinquencies with auto loans, and there's some concern with credit cards, but nothing crazy at this point. So I want to see a material true deterioration in a series of different data points before I'm ready to basically throw myself off the bridge, which I think some investors essentially did yesterday. And then they immediately course corrected today, most of these traders, particularly in the Japanese markets, by just going right back up because it maybe was a bit of an overreaction.
And I think that the Fed is of a similar mind, but perhaps they take that a little too seriously. Insofar as, something that you frequently say is they're always late to the game, right? They were too late in correcting inflation, and perhaps now they're going to be too late in relaxing monetary policy to then, let the economy normalize.
I don't think you'll find anyone as basically as hawkish as I was in the early days, because when the Fed embarked on basically increasing monetary base to 5 trillion, which then led to it being circulated in the economy via M2, which would be like money markets and checking accounts, et cetera,
right.
which is truly money that's in circulation in the economy, or has the true potential of being in circulation, as opposed to like sitting in the vaults of a bank. When that occurred, I knew that within short order we would start to deal with serious inflation in a way that we hadn't in basically a generation. And my biggest critique of the Fed at the time was, if you're going to do this, you can't then just sit on the sidelines and wait forever to raise rates. You quote stimulated the economy, and we can have our disagreements on whether that was the right or the wrong thing. I didn't think it was a wise decision. But if you're going to do it, then you do eventually have to follow through with raising rates in time so that you don't have a runaway inflation problem. And they were just late to the party. And so then I was always of the mind of like, the Fed needs to remain really hawkish throughout this whole thing. But then when you're done, you're done. And so then it went from me feeling like the Fed needs to stay strong, don't be bullied by the media, don't lower rates too soon. And even for me, I'm like, what are they doing now? Like, at some point, you've tightened so much, you've pulled inflation down pretty dramatically, in my opinion, north of 9% back in June of 2022 to now basically south of 3%. We've made material progress. Don't wait forever and keep borrowing costs elevated and drive us into an unnecessary recession. That's my biggest fear. And I think as an investor, what you should be watching is, if the Fed remains hesitant throughout the next couple of meetings, particularly in September, if there isn't a rate cut, I think more volatility is ahead, and I think a lot of traders are going to trade off of that. And I think people are going to be shorting the markets, which has got to be in the head of Jerome Powell and the Fed governors. I think they've got to feel this pressure naturally that if they don't engage in some type of cut, the markets are going to punish that decision. And so human nature is human nature. I think that's going to play into their psyche as they get into it. But I'm with you. I think they were late to starting their rate hikes, and now they're late to doing the rate cuts, and I think so many people in the industry are always frustrated with the poor timing of the Fed. So now, that said, there is talk now that they're considering a 0.5 point cut as opposed to a 0.25% cut.
Right.
So if we have a full 0.5 point cut, that would be fantastic. I think the markets would digest that, which is why I think this market could bounce back really quickly, Pat. is if we then see a very accommodative Fed moving into the next month, that is going to send positive signals to the market. And then if that is subsequently followed up with unemployment reports that either remain level or maybe tick back down a little bit, the markets are going to digest that very confidently and in stride. And that's where the second half of the year could be pretty positive if you're patient as an investor.
Yeah.
I am not prepared, though, back to what we were talking about a minute ago, of just saying, well, this is just going to be some massive recession and these are the early signs. It is way too premature to talk like that. And it was interesting because I read a lot of articles that was suggesting that we were on the verge of the big R word. And then it seems like all these articles out today are like the opposite. It's just amazing how fickle the financial media and investors really can be day to day.
Right.
So
it seems like the media does drive a lot of the movements in the broader markets, and especially if you're looking at indexes like the Nasdaq or S&P 500. Recently, with the Magnificent Seven, it has been a lot of hyped up companies with stretched valuations.
Correct.
And you have to wonder, is the high borrowing costs combined with momentum swings, or not momentum swings, but sentiment swings in the market, is that really going to weed out the fundamentally sound companies from the ones that are just a fad?
Yeah, I mean, so let's talk about the valuation thing. The price to earnings ratio on the broader market, which for people who don't understand PE ratios, it's basically just a nice way to measure whether something is deemed expensive or cheap. Mm-hmm. And so on average, it's about 16.6% or 16.6 times earnings would be sort of average. I've always told people 16 to 17, even 18 is a pretty average priced. You go to the car dealership, you're paying an average, cost for the car, and you're getting your car. And then there's times to go to the dealership and it's like, I went and bought a truck a couple years ago and the MSRP was like $5,000 lower than what the dude was trying to sell it to me for. And I was like, come on, man. Like I'm not buying it for $5,000 over MSRP. And eventually I held my ground and they brought it down below MSRP because I knew it was like a harsh negotiation tactic. So think of it as like, look, the truck on the lot got too expensive and PE ratios are indicating that the markets are too expensive. And MSRP is at, say, 17 and the markets are at 21. And this is according to the JP Morgan guide to the markets. That's where we were. I think the markets were overinflated. And here's what happens. This is why I think the unemployment data was traded on so dramatically. I think deep down, it was less about this implicit fear of recession and had a lot more to do with finding the one excuse, the reasonable excuse to finally take those gains. Because you have to remember, people have made like 10x on their NVIDIA trades.
Yeah.
Right? And people have made dramatic amounts of money on the Magnificent Seven over the last couple of years, and particularly on the AI stocks. And there reaches a point as an investor where you feel this like deep-seated anxiety of, I don't want to lose out on the gains that I've made. And so, oh my, here's a signal over here suggesting that we could be like ripping into a recession. I don't want to do that. I'm going to sell now. And so I think between the Fed's hesitance to go ahead and lower rates in the prior month, and not really giving us a strong indication whether or not they were going to in September. That was the first straw. And then the second straw was the fact that unemployment did come up, particularly from the prior year. It came up a fair bit, only a little bit from the prior month. That was just enough justification to drive valuations down. So unlike Japan, which I think was a little bit more emotionally driven on fears of recession, the U.S. was a twofold. Genuine fears of recession, but also even if we determine, like you and I are feeling, that we're way too early to say this is a recession, even if we determine that, I'm not convinced the markets are going to just immediately go right back up to all-time highs, because I do think there was a valuation situation. There's a valuation problem, and that situation is being resolved by markets coming down a little bit.
Right.
So I think we might see healthier valuations, and this is something that I wrote in the article is, I see this as a reset, not a recession.
Right.
That's where I really see this market's going. Yeah. Can we talk for a second about 2008 and 9, because I'm seeing a lot of people talk about 2008 and 9, and I think it's interesting because we've already recorded several of these episodes and we're about to do a whole series on the financial crisis. But I continue to see the temptation of the media and other writers in the economics and financial world, I'm seeing them start to like drum up this is the next 2008 and 9 big collapse and financial crisis. Or it could be like, the late 2000s, the late 90s, where long-term cap management, that hedge fund blew up, and then we had the tech crisis and all the other things. I think the fundamental difference between the long-term cap management hedge fund, which was betting on the Russian ruble, is that there was an immense amount of leverage and risk-taking that was occurring in the financial industry in the 90s, and particularly bad in the 2000s, that we're not seeing to the same order today. So when someone says like, "Oh, we're on the verge of another financial crisis," I think that's really doesn't square with reality. I'll give, let's do a little juxtaposition. And again, I mentioned this in the article. So I was looking at the bank failures that occurred last year. So think about this. Silicon Valley Bank fails, and they made a bad bet, like a really bad bet, right? They did this whole duration thing where they were convinced that the Fed was not going to eventually raise rates, and they actually were trying in their mind, I believe, to be prudent. And on their balance sheet, they're trying to keep a lot of safe assets so that if there was a run on the bank, they could sell off. They were buying boring treasury bonds, Pat. Right? They were buying 5 to 10 year treasury bonds, like a total snooze of a balance sheet, which in theory shouldn't have gotten them into trouble, except when the Fed all of a sudden decides to dramatically print a ton of money and then raise rates quickly. And when that happened, they got stuck in a duration trap because the old inverse relationship between interest rates and bond valuations, because they owned 5 to 10 year bonds, their balance sheet lost like $30 billion, $40 billion in a snap because they were owning what should have been classic safe investments.
Right. I mean, the risk-free rate.
Yeah, the risk-free rate, they basically ended up getting hammered. But then, so think about, they got hurt on treasury bonds. Now let's compare it to 2008 and 9, where people were buying juiced up subprime mortgage-backed securities and collateralized debt obligations with fake ratings from the rating agencies. A real estate market that was predicated on a vast overproduction. So 5 million, I've heard different estimates, 5 to 7 million of an overproduction of homes between 2000 and 2010. And so you've got a faulty market with financial instruments that were predicated on the faulty nature of this market for a variety of reasons. I mean, you had the Community Reinvestment Act that goes back to the 70s and then was kind of retooled in the 90s, pressuring like Fannie Mae and Freddie Mac and a lot of these major corporate banks. There was a lot of pressure from activist groups like Acorn to lend, by the way.
To give people the American dream.
To give them to the American dream because they didn't want to be prejudiced. And in one sense, I understand the desire to lift people up, and I appreciate that. The fundamental problem was they were giving loans to people with no income verification and super low down payments, oftentimes even sometimes lower than 3.5%. There were some loans that were at zero, by the way, literally 0% down payments. I don't think those are super common, but the fact that it happened is just crazy. So you've got loans that are being these subprime loans that were just totally faulty, that were then being packaged, and then commercial banks were putting those toxic junk assets on their balance sheets.
Right.
So again, when people start to say, well, we're heading into the 2008 and 9 crisis all over again, here it comes. I would just say, can you do an honest comparison? Silicon Valley Bank, although is a serious problem and it could have led to more bank failures, feels relatively benign to me when you really do a quick juxtaposition to the types of stuff that they were doing in the 2000s. And then one more quick thing that I will say is those bank failures, First Republic, Silicon Valley Bank, and there's a third I'm spacing on, they were closed down. They were put into FDIC receivership. There was a new purchaser that emerged for those banks. It was very orderly. They didn't perpetuate moral hazard by just bailing these banks out, which I appreciated. And it was wound down in a decent fashion. And you didn't see a systemic spread. And I was genuinely concerned for a while, Pat, that this duration trap thing that Silicon Valley Bank got caught in, I was worried because this happened in the savings and loans crisis in the 90s and in the 2000s and in the late 80s and 90s. I was worried like we're going to go through a wave of a savings and loan crisis. And actually, this has been relatively contained and isolated to just a few banks. So sorry for the long dissertation here, but I just want to point out when people start going down these dire paths or these really dramatic recessionary narratives, I think it's really important to do a comparison of what's actually going on. If we hit a recession, it's not going to feel like 2008 and 9. It's going to be quite different, in my opinion.
Right.
Because the building blocks of what's happening today are very different than what happened in that time frame.
And if it's, COVID-19 was what we like to call an exogenous shock, right?
Correct. An exterior shock.
So even if we do have another recession, it probably won't even feel like 2020 to 2022 either.
Correct.
It'll be a little more textbook, I think.
I think so too. I think we're looking at your typical equity markets down 20 to 30%, unemployment ticking up, maybe to 6-7%. Obviously, I don't have a crystal ball and don't know, but I see this being more of a sort of a standard, maybe mild to moderate recession.
Right.
Thankfully, I don't see these really wild risks that had occurred even in the 2000 crisis. I think that was largely, I think that both the tech crisis, which in some ways was stacked on top of the instability of financial institutions, the implicit instability that existed with that hedge fund long-term cap management, which then had exposure with the major corporate banks and the Fed silently bailed them out. That type of instability got ramped up in the lead up to the 2008-9 crisis. Thankfully, as of this moment, and maybe my opinion changes, but as of this moment, I don't see that level of instability in this time right now.
Right.
And again, I think let's talk about the housing market as well. The housing market's literally the opposite, where we had a glut of homes with prices rising in the face, which just defies basic economics. If there is an increase in the supply of something without a respective increase in demand, then prices by default with excess supply should decline. That's how oil works. Mm-hmm. When there's way too much oil, the prices go down. Or there's way too little oil, the prices go up. It didn't do that. That's the sign of a bubble, and the bubble burst. This time around, people are saying, well, real estate prices are going up again. Yeah, but why? Real estate prices are going up right now because there's a 5 million home shortage, according to some estimates, which is literally the flip side of what the housing market was then. The housing market is bid the price up because that's what that's what a healthy market economy does. It's going to bid the price up in the face of shortages, which probably means that the housing markets is going to cool over time as they ramp production back up. But it does not spell bubble or blow up the way 2008 and 9 was.
I agree.
I think this is maybe like the early if we have a recession, it's probably more like in the early 80s we had a couple mild recessions, and that was in the face of the Federal Reserve raising rates dramatically than the way we did now. And so that's more what I see as potentially a mild recession like we saw during the Volcker years, but that was subsequently followed by one of the greatest stock market bull runs in U.S. history throughout the latter part of the 1980s.
Yeah.
So I guess that's my encouragement to people right now is, one, stay the course. I don't think we're heading into a terrible recession. And even if we do head into a recession, my prediction is probably on the milder side of things. And eventually you'll start to see, I think, potentially great growth rates because there's still a lot of opportunity in this market.
All right.
Anything we missed here about this market?
I don't believe so.
Okay.
Yeah.
My general sense, I guess, my general sense, Pat, to close this episode is now is not the time to panic. This is likely a reset. I think you can anticipate volatility for the remainder of the year, or for at least for the remainder of the next couple of months. But it is not a point at which you fundamentally change your strategy. Caveat on this. I do think some investors don't have the stomach for a market like this because I do think it could be volatile. And if you don't have the stomach, that's where you maybe need to explore alternative investments, and you need to diversify your portfolio in a way that reduces some of the gyrations that you might experience in the markets. Do you have any thoughts on that?
I completely agree. And one thing most people think of investing as stock picking, right? But there are other ways to invest. You still invest in stocks, but there are other ways to build your portfolio that can mitigate some of these choppy seasons. Yeah,
I agree. And the thing about certain alternative investments is that they have a low or no correlation to the broader public markets. And for the right investor, as we get into choppy waters, that might be important to have access to those types of low correlation products that aren't going to just track with the traditional stock and bond markets. I did think of one more thing before I end this, and I'm curious on your point, so I'm going to throw this out at you. One of the, I think, and maybe this is an unfair statement, one of the places I think people are tempted to perceive as a place of safety are cryptocurrencies, right? And so there's a lot of literature that's going to demonstrate a lack of correlation between crypto and the stock market, which is true. There's not a tight correlation there. There's also not a tight inverse relationship either.
No, I mean, I don't know if you checked, but I was looking at it on Monday yesterday. Bitcoin got slaughtered.
Got smoked. So Bitcoin has a very high standard deviation.
Yeah,
right. And yeah, does it track closely with the markets in general? No, but it always tracks closely with the markets and seems to like magnify the problems of the markets is when it's bad.
On bad days, yeah.
Correct. It seems like if the market's getting smoked,
an incredibly sentiment-driven asset.
It is so emotional. It's great.
One tweet or X comment from Elon Musk could be like a toilet bowl, like rising in the air, and all of a sudden Bitcoin like goes up 20%.
100% true. And I think I think back to say 2020 when the markets were getting smoked and cryptocurrencies were just getting slaughtered then as well. Yeah. But I still hear all this chatter of like you should own crypto or you should own other asset classes. Like when we talk alternatives, we're talking about investment strategies that can potentially reduce volatility in a portfolio when the markets are down.
Right.
And so that's where, whether you like crypto or not, and by the way, I personally own some Bitcoin, so it's not like don't have some skin in the game. I do not view my Bitcoin as any way of creating any degree of hedge on my portfolio. I actually view it as actually adding a little bit of gasoline to the fire right now. But I'm okay because I'm a long-term investor. I think it'll come back. But I did want to touch base because I just always noticed this trend where crypto gets beat up pretty good when the markets are down.
Yep.
But all right, Pat, I think we covered it today. Thanks for coming on. Thanks for asking questions and listening. And we'll see you all next time.
All right. Thanks, Drew.
Thank you. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn. Or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.